Hey traders, welcome to Charts and Coffee. Hope everyone is having a good Thursday morning. Happy Thursday to everybody. Let's take a look at what we've got going on in the broader averages. As always, if you have any questions, feel free to type them on in. We'll take a look at what we're dealing with in terms of the volatility. Has it calmed down? Where are we in terms of the trend? Have we broken the downtrend? Where are we in terms of potential support and resistance? We'll take a look at all that here this morning. So we'll kick it off with the S&P. And if you take a look, so everything, gang, that we do as traders, everything that I try to do as traders, at this stage in my career, it's really been a process of, hey, there are things we know how to do and recognize manually. So if there is a step-by-step process to that, then we can automate it. And if we can automate it, we add accuracy, we add speed, we reduce, if not darn near eliminate, a lot of the bias and emotion around our analysis. And believe me, if we're long, do you think that when we look at something manually, subjectively, that we're going to look for reasons why we should be short? Or will we just look for things that confirm the bias that we have because we have the long position? And I found that for myself and lots of traders, that's exactly what happens. There's that old saying, are you bullish because you're long? Or are you long because you're bullish? And for a lot of traders, they're bullish because they're long, and they'll look for all the evidence that that is indeed the position. Well, same thing goes to the short side right now. The downtrend on the daily time frame of the S&P is broken. We have our first two neutral candles. I'm not saying we couldn't get a bit of news. We know that the downtrend in the S&P, the NASDAQ, the Dow, the Russell are not because of market internal reasons. This was not a disappointing earnings season or two. This was not a monetary policy misstep, although some people might argue with that. Most of this are external reasons. And that means the same external reasons likely that got us here, the same external reasons, when resolved, will get us out of this. The neutral candle just basically says the maximum fear that we had back on April 7, we just haven't got there again. We haven't seen that max fear again. And look, if you're a fearmonger, you can point to lots of things, but we always want to go right back to the data. What is the data telling us? Let's head on over to the NASDAQ. We are in the midst of earnings season, and we saw how the Tesla earnings, this is where it's a really good contrast of expectation versus reality, or perception versus perspective. The expectation was that, Tesla might miss. They missed by a lot, right? Then we're concerned that it could drag the NASDAQ down because of the weighting. Those are all very realistic possibilities. And then the reality was, in a 90-minute phone call, these terrible earnings actually created what? A gap up. So this idea of news as fact, or this idea of news as being something directionally tradable, is not always going to be the case. In fact, a lot of times, if we've already embraced that something pretty bad is going to happen, it's priced in. And that takes us back to that April 7 low. So as long as we don't end up in a scenario with rumors, with expectations, with fears and facts of something being worse than the S&P, for example, priced in on April 7 with that low down in here, which, by the way, had just exceeded the 20% from the all-time high pullback. That's what that low represented. As long as we don't get back down there, we might start to normalize, and price action and participation are showing that that's what's happening. All right, now, is it still heavy, right? I talked about support and resistance. Yeah, it's still very heavy. We still have a huge set of overhead resistance levels between, say, 57.50 and about 57.60 on the S&P futures. We still have some significant resistance at about 55.20. But just because there's resistance overhead doesn't mean that we're in a downtrend. I would look at this as bearish chop. That's what I would look at this as. So that's where we sit. NASDAQ, same story. Here's the Dow. You can see the Dow is a little bit different. All right. So this is the next lesson we got to think about in environments like this. We can't paint all the indices with the same brush. So what that means is, while the components, the stocks, the sectors within the S&P and the NASDAQ, which are slightly different than the Dow, When those are behaving in a different way, those indices can benefit, in this case, go to neutral, while the Dow is still pretty heavy. So what's weighted within the Dow? What's weighted within the Dow are things like, obviously tech, but mostly financials, healthcare, energy, industrials, transports. The main overlap between the Dow and the S&P is with tech and financials, a little bit of energy. The main overlap with the NASDAQ is tech. So the Dow has a set of sectors clearly that are heavier, that aren't either weighted at all or weighted significantly in the other two indices. So think about that. We don't want to paint the entire marketplace, all the indices, all the sectors with the same brush. Because when we do that, we can miss out on potentially some sectors that, for reasons of their own, maybe earnings, maybe whatever, right? News, macroeconomics, they're starting to go neutral and or break out. So that's another thing too. In downtrends, not everything's going to be weak in the same way. In uptrends, because we have oftentimes uptrends powered by monetary policy, lower rates, money printing, that's oftentimes where a high tide, a rising tide, can lift all boats. And those are things that will be distinctly different in uptrends versus downtrends. We did our workshop for the Sector Secrets Mastery Immersion, an ongoing class. And yesterday we talked a lot about the difference between uptrends and downtrends. And if you've never dealt with a significant downtrend, let's say you weren't trading in 2022 and didn't see that 9-month 20% pullback, this took just a handful of days. But if you've never seen significant pullbacks like this, if you've never traded through significant pullbacks like this, downtrends are far more susceptible to short squeezes, which are bursts of buying and sellers covering their shorts. They're far more susceptible to that than uptrends are to long squeezes. Yes, it goes both ways, but short squeezes are far more violent and far more common in downtrends than, say, a sudden pullback in an uptrend would be without some sort of external reason. And this is where a lot of the difficulty in finding follow through can come. So Eddie says, apology for being late. Couldn't find my coffee. I'm just getting to mine now, Eddie. First 2 sips of the morning. All right. So if you have any symbols you want to take a look at, again, feel free to type them in. Let me know if you've got a position in that symbol. Let me know if you're bullish or bearish, or even what time frame you're looking at. And let's take a look at a few other futures contracts. Remember that there's been a lot of talk about the stock market going to 24 hours a day. Please remember, most of the futures, the important ones, the ones that most traders look and watch and track alongside the stock market, S&P, NASDAQ, Russell, Dow, bonds, gold, crude, silver, copper, a lot of these are trading darn near 23 hours a day. So we do have almost, not quite, but we do have almost 24-hour markets. And that was a conversation we were having in the mastery yesterday. Some of our Sector Secrets traders were saying, hey, Rag, are there opportunities after the close? And I'll say, yeah, usually in the futures contracts. And we want to focus on that when different financial centers are open. So when we start thinking about the bigger picture of where we're heading, let's talk about this crude oil market and copper. All right. Crude oil is certainly not moving for reasons only of supply and demand, or reasons of OPEC's pumping or not pumping. Crude oil is also moving, obviously, in many ways based on what's happening with the perception of how much more output are we going to expect, not only from OPEC, but also from the US. And output is supply, and more supply is typically resistance, right? So obviously we have a lot of resistance in crude oil. But another thing to remember is crude and copper tend to rally together when there's economic optimism. This is not the case. Usually, if you want to differentiate sort of a confused individual narrative, maybe it might be policy shifts, whatever. In an economic optimism type environment, these two, crude and copper, should be moving together. So that leaves us with, okay, Rag, what's the story with gold? Look, gold has been a story for almost the entire year. In the Sector Secrets Mastery, our first long position in gold was back on specifically the 27th. So we found the green candles, it went down into the zone. If you've been watching charts and coffee, you know this setup. It's a volatility support based setup in a bullish environment. So we've been doing that, on and off for the better part of over 2 months. But what's really interesting as of late, the story's gone mainstream. There really wasn't a lot of talk in a mainstream way about about gold until it got above, as you can see here, 3,000. And then this became sort of a mainstream narrative. And so you took this very quiet climb, and a very nice one at that, from 2,700 an ounce to 3,100. And then, right around 31 to 3,000, things went really crazy, because now you've got a whole different set of eyes, a whole different set of discussion. Trading gold is still going to be viable, but it's going to be a lot different. It's going to be more volatile. And you've got, as you can see, evidence of that volatility. I do want to get long gold, but I'm not going to buy gold on these highly volatile days with the presumption that a really big down day must be met with a bounce. It doesn't, right? Here was a really down day on the 3rd. It was met by another down day on the 4th, and yet another on the 7th before it rallied. So then my question is, how many traders could handle a pullback from, say, 3,150 to 3,000, or 150 points of gold, and still manage to hold the position without adding and increasing size and risk to the account? Most traders can't. They're going to get stopped out. So this is where I say, once we can normalize to volatility that reflects the 68% of what we usually see, I'll absolutely get back in gold. So Smoke Divine asks, am I short gold? Oh, no way. No, can't, won't and can't. I would not short gold. We've been buying gold consistently on pullbacks since the end of January. The most recent trade that we had in gold were the GLD calls, which is a great alternative to trading the futures contract. We bought the 295 GLD calls, and that was a great run that we just took advantage of up until just the other day when we got our trailing stopped out. We took $465 options to just over $1,700 per contract. Would I like to do it again? Yes. Am I going to short gold? No, gang. I'm not going to top pick, right? Yes, there are going to be times when we hit some sort of resistance level, like here, or whatever this was. But if we think about it, if this is the flow, and it is, if this is the flow of the river, am I interested in these little pullbacks in the overall movement higher, or would I rather just be a buyer at those pullbacks? And I'm definitely a buyer at those pullbacks. I'm not a fan of saying, well, something's gone too high and let's buy puts. I'll buy the calls, and like I said, we've been doing that consistently since the end of January. And until or unless that structure changes, Smoke Divine, until or unless it changes, I'm not going to change that plan. I'll still go with the flow. All right. Harry asks, morning. I've been watching CMS. Okay. I'm watching CMS, an energy company, alongside XLU, being in a weekly squeeze. We possibly take a look at this, please. All right. So for those of you that may not be familiar with the squeeze, it's a setup that John created many, many moons ago. And it's a funny story. I remember meeting John for the first time back in the early 2000s. So I've known John for about 25 years. And he came down to, I live in Florida. He came down to a trader. There's a really big trading club just outside of Fort Lauderdale. And he came down for that. And he talked about this idea of Keltner channels and Bollinger Bands. This was before all this stuff was automated. And what he basically did is figured out, hey, this is what a symbol looks like before it breaks out. And I thought that was a really interesting way of looking at it, because breakout trading is really a popular style. And so anytime I'm going to look at a breakout trade, right, I've got to have some definition of where the support and resistance is. And if that support and resistance can coincide with a squeeze, can coincide with a minor low, can coincide with some sort of maybe volume-based breakout, what you're going to find is the follow through from a compressed market is going to be really, really good. So that's the first thing I look at. We might have different compressed markets of varying heights, if you will. So just on this chart of CMS, and you mentioned a weekly. Okay, but let me just use this daily and then I'll go to the weekly. So see how this is a smaller compression? That's what I typically will focus on. This is a much larger compression. It's a much larger range. Now you mentioned the weekly, so let's jump on over there. Okay, so if I'm looking at CMS, same thing. What I'm going to do is look at where it was compressed, where it might be compressing. So whether it was back in here or back in here, right? This is a little bit larger a range. So this is what I'll do, and this is what I teach my folks in the mastery. And I think if you're looking at these breakout, compression to expansion type setups, you're going to find this is going to work really well for you. I don't like buying breakouts, but I do know that breakouts are where a lot of times that acceleration can be extremely profitable, right? So what I like to do is focus on pre-breakout or almost a pre-squeeze, right? So what I'm going to do is I'm going to take a range like this, which is automatically defined by the Darvis 2.0. I'm going to cut that range roughly in half, okay? Then I'm going to cut it in half again. I know that that's not perfect, but you get what I'm looking at. I'm looking at the lower half of this range. And what I'll look to do is I'll look to buy calls in these areas, or in the case of CMS, maybe you're buying shares. And what I'll do is I'll take advantage of the pre-breakout. So up here, we could say would be the breakout, right? So what I'll do is I'll dig my heels in down in here, which gives me the choice to maybe use this resistance level as a target. And if we break out, great, which is what everyone's looking at for some sort of expansion or breakout move, that's when that T2 is going to capitalize on that, break of the resistance level. And that's how I do it. So, Harry, that's the way I would look at that CMS on the weekly. And that's the way I would break that down. It's all still definitely within the confines of we've got a range and we would presume it's going to break out. The wider the range, the more likely I'm going to just cut that in half, cut it in half again, dig my heels in that lower half or lower quarter. We call it cutting the sandwich, cut a sandwich in half. And then that way, when the expansion, the breakout, in the case of your question, the squeeze fires, I've either already got a position, and now I'm talking about T2s, or if I wanted to put on a secondary position with the breakout, that's obviously a choice that you can make. So I appreciate the question, Harry. Yeah, a lot of folks ask me, Rob, do you use the squeeze? Look, I think what you'll find with John and I is a lot of our stuff are going to overlap. I think we're going to find ourselves on the same side of a lot of trades, not all the time, but because we're looking at factors, we're looking at price, volume, etc. Great trades don't happen alone, right? You're never alone in a, what happened, puppy? Sorry, that was my doggy. What happened? Great trades don't happen by themselves. I'm never alone in a successful trade. So I try to keep in mind that there are going to be multiple reasons that lots of traders are looking for something. And when they coincide, especially if they coincide with someone I know knows what he's doing, great. I know I'm on the right side of things. I just like to think of it as a pre-squeeze, right? I like to be in that oversold part of that range and take advantage of the breakout as leg 2 of what could be a really successful trade. All right, last question for the day. Kaushik asks about MSTR. I like it, right? I've got the 5 green candles, and then now I look for a pullback to this area. And when I do, I'll get long. Yeah, it was MSTR, right? Sometimes when I see MSTR, I see there's 2 big MNST, MSTR, but yes, MSTR is going to move a Bitcoin, but I would have to wait for about 318.80 for that entry or a pullback into that volatility zone. All right, gang. Thanks as always. Get those questions in early. Thanks as always for being here. I'll see you tomorrow. Same time, same station. Be good to each other, gang.